And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
And good morning. And today on Real Investment Show, we're going to start with a little ditty. Yeah, I know. Got to get one segment done and then move to the other. But we're glad you're here. We're going to have Michael Lebowitz with us today. When we come back. I'm so tired. I've lost my ability to speak. We're in for a little bit of a storm here, so Mike is going to really clear up some information for us about the Fed, how they're going to move. We had JPMorgan just released their second quarter earnings. Their profits fell 28% after building reserves for bad loans. Looks like their earnings came in short as well as revenue. But in the meantime, we're all sweating our you-know-what's off. So I've written something just for you. There are clouds in West Texas, so my dryer can't run. There's no wind in West Texas, so my ice cream is done. All clouds, no wind in West Texas means this new deal is a pass. There are clouds in West Texas, and you know what that means. ERCOT can kiss my... and welcome. Glad you're here to join us today. We are living in a surreal world where up is down and down is up and sideways is who knows. Interesting story before we get into the mess of the Fed. There was, I just did an interview with another radio station, I won't say. And they said, well, listen, Rich, how do you save money through this period of time with inflation where it is? And I want to talk to Michael a little bit about the flexible, the sticky CPI, or the Atlanta's looking at the flexible cut of the CPI versus the sticky cut. And Atlanta Fed does a great job when it comes to inflation analysis. And there's something very concerning going on with the sticky price part of that, or prices that don't change much and where the inflation levels happen to be. So we're going to talk about that. We're going to talk about, again, everything that we need to hear about the Fed. But people are going to thrift stores more than ever. We talked about that on this interview. We also talked about there is a YouTube channel, right? This is Clara's Depression Cooking. Clara has close to 7 million views, almost as much as Lance Roberts on YouTube. And what she is doing, she's 98 years old, Nana Clara. And she is coming up with all these, she's not coming up with them. She's revisiting all these recipes that she had made as a child.
I was fixing to say, how old is she?
She's 98.
And she probably wrote these recipes.
But these are recipes even I remember, Brent, as a kid. Like macaroni and peas, right? There's a lot of pasta in there. Lots of potatoes in there, right?
Lots of potatoes.
She's got a poor man's stew, and she goes, my grandkids love this stew, right? But I'm amazed by, I talk to people and go, hey, you ever heard of, Clara and her depression cooking? They go, oh, I watch it all the time. Where do you think I'm getting my meals? The concern I have when it comes to the Fed is, yes, they can create demand destruction, but we have got a supply problem, whether it comes to our own bonehead policies with energy and drought and Ukraine, that are prices really going to fall to this Nirvana 2% target that the Fed is always examining? We'll have to wait and see. But one of the tips we also had is the actual activity at thrift stores is at an all-time high. Gen Z pretty much always shops at thrift stores. But this is a woman in Philly She went to a Goodwill and she bought a Coach bag for $6.99. Right? Real bargain. So she takes the bag home, and it's pretty dirty. And she tries to remove a flap at the base of the bag, and she does it. And here's what she finds. She finds an envelope with $300 in cash and a long note that was inside the envelope, which the shopper read. It says, "I have 3 children. They will give my things to Goodwill when I die." Obviously, they did. So I'm putting their inheritance inside all my favorite things. The Coach bag was given to me years ago by my husband's girlfriend. The letter then took a detour. Well, actually, I came home early from a visit to my parents' house in Connecticut. She must have left quickly because she forgot her bag and shoes. So it just talks to you, hey, listen, how do you want to go ahead and leave an inheritance? And yet you want your kids to find it? I tell you, Brent, this is one of the most interesting stories I've read about an inheritance.
Oh, yeah.
And that comes up years ago. So she goes, in this letter, she goes, "I carry this bag every day. I wonder if my husband ever knew this was his girlfriend's. I carried it daily, and by giving it away because my kids don't want it. So go buy yourself a new bag. Love, Martha." But unbeknownst to Martha, she would gain a dedicated herd of fans from the video of this woman, Mrs. Silverman, who bought the bag for $6.99. So you might be sitting on some incredible treasure at thrift stores.
I'm going to go home and check out the flaps in my wife's purses.
That's sort of personal.
Or not.
Dear Brent, stop snooping. Love, Darlene. Oh, and the dog peed in the living room again. But Martha was clearly a badass. Obviously, she was hoping someone would find that, but at least maybe her husband would have found it or her kids would have found it. It's just so funny that it was in a thrift store. How you leave an inheritance is obviously really important, and some people are pretty creative when it comes to that. The key is you got to communicate while you're still alive. Obviously, Martha felt it was important to communicate after the fact, but boy, she did get the last laugh, obviously. So she's got a lot of admirers, right? On the Coach's brands, on Coach's TikTok, Coach commented, "Martha is an icon." Oh, again, this is out of Goodwill, right? And then there's another story, $34.99. This woman, Laura Young, walked out of a Texas Goodwill with a 2,000-year-old Roman bust that had been missing since World War II. Why are we here this morning? We should be at the thrift stores. Amazing. When you find a good deal, you just might be finding your retirement fund at Goodwill. Did you ever think of that, Brent? No lottery tickets for you. It's Goodwill. We get back, we've got the professor, Mike Lebowitz, to, unravel this mess that we're in with the Fed and inflation. When we get back here on The Real Investment Show. Stay tuned.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hurricane season is here, and along the Texas Gulf Coast, we know how to prepare. What we don't always know is which way the storm will go, and if a hurricane does come your way, whether your house will flood. Fortunately, you can get flood insurance. Unfortunately, flood insurance rates have skyrocketed. Don't be at risk. Let the specialist at RIA Insurance assess your needs and shop your coverage for the best rates possible. Another service from realinvestmentadvice.com. Click on the insurance tab, realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And we're back. Good morning. Lance Roberts back on Monday. We have Financial Fitness Friday tomorrow with Mr. Ratliff. And what's coming is Inflation Nation. Well, you're already in Inflation Nation, but we have a 9-step inflation battle plan for you. And that's going to be Thursday, August 4th at noon. It's your lunch and learn. Maybe you would make your lunch using Nana Clara, one of her recipes.
Mac and peas.
Yeah. Mac and peas, not mac and cheese. Can't afford cheese anymore.
Yeah, really.
I wonder when the government's going to start issuing cheese again.
It's too expensive. Yeah. All that government cheese, it's in Fort Knox.
Did you read the story about the guy that found an old can of government cheese and decided to open it? There's a guy on YouTube that tries everything old. He finds old food from like World War II and so forth, and he eats it.
Ew.
And just say, well, I don't know, still tastes okay. And all that. This is where we're all going to be going, Mike. So this is going to be our 9-step inflation battle plan. How to micro budget. Should you postpone Social Security for a higher COLA? The estimate, we're going to talk a little bit more about this tomorrow, but the estimate for next year's cost of living adjustment is close to 10%. How to renegotiate your credit card interest rates. Listen, you can do it. It's not easy, but you can. But right now, we're here with the professor. Oh, I'm so happy. This is Janet Yellen to be with Michael Lebowitz, although he does pick on me a lot. And I don't know if your mother ever taught you not to pick on old ladies. Thanks for being here, Michael.
Richard, you sound just like my mother.
Give me a hug, Michael.
I didn't know my mom was going to interview me today.
I am morphing into like a 98-year-old woman. So
unfortunately, she doesn't listen to the show, so I can say whatever I want about
Mama Lebowitz. Well, listen, there's so much to unpack here. I don't even know where to go first. But I was thinking maybe we can hit what's your thoughts on JPMorgan this morning and what major banks are going to say. Well, first of all, about their own earnings and what you think is coming up. And also what you think they might be going to say about credit card usage as people in households are getting more distressed and going to credit cards for the basics.
Yeah, JP Morgan's earnings came out today, and they were not good. Their revenue, their earnings, a bunch of data they put out was below estimates. Mm-hmm. I think that the most troubling part of this was not, I think a lot of that was expected, and we should expect it for other banks, but they suspended share buybacks. That's, I think, the big ticket item within everything they said. That tells me they're battening down the hatches, right? They're trying to save capital. That's not necessarily saving money, it's capital. They have a bunch of capital requirements they have to meet, and they must be concerned that losses are going to start increasing and that they don't have enough capital, or that they may need, they want to buffer their capital base to withstand a storm that they didn't think was going to be as big prior to suspending share buybacks. So, it doesn't mean we're going to have a depression, but I think JPMorgan is getting conservative here, and they're saying, we don't know what's coming. The Fed is now potentially going to raise rates by a full percent and keep raising rates throughout the fall.
Right.
The economy is slipping. Whether it's in a recession or not is very debatable, but it's certainly heading in that direction. And JP Morgan is I don't know how they could warn you any more than suspending share buybacks.
I agree with you. And they're actually heeding Jamie Dimon's warning that there's a storm coming.
Right.
This is what is a little unusual about this, and tell me if I'm incorrect, is that to see a bank actually preparing for a storm as opposed to going into it and then asking to be rescued.
You know what? This is a well choreographed situation. The Fed has been pretty open. The Fed has been pretty aggressive. I think we all know how dependent the economy is on the level of interest rates. And I think everything has been gradual. The stock market is off about 20%, but there hasn't been panic for the most part. Bond yields have risen, interest rates have risen decently. There's not really panic. It's been gradual. And whether that's because the Fed has been very open about what they're doing and they're fighting inflation, and they've made that very clear. Inflation is public enemy number one.
Right.
And they don't care. I mean, they do care about jobs. They do care about the economy, but they've made it very clear that they have to get inflation down. And I think there is some solace in the markets because of that. Because they realize that if the Fed goes back to their old ways and says, oh, no, we're going into a recession. Oh, no, JP Morgan stock is down again. We got to start easing or we have to stop tightening. They really run the risk that they lose control over everything. Even though, I think a lot of people will tell you, well, if the Fed were to say today that they're not going to tighten rates at the end of July, the market would rally, and maybe would rally for 10 minutes. But I think the bond market would be a disaster. Yields would shoot higher. We'd be talking about 7% mortgage rates, 8% mortgage rates, and the stock market would then follow the bond market. So the Fed's, and we've talked about this before, they're in quite the predicament. And JP Morgan knows it. We've heard it from so many different other corporations. We talked a lot about Target, Walmart, even Restoration Hardware we write about in the commentary, because they've been kind of, believe it or not, on the leading edge of this whole thing.
Right. And they're a great indicator.
Very early on and continually warning.
What did you say, which was interesting, that this is really one of the first times we've seen wealthier households pull back on spending. And that's what you see in Restoration Hardware. But I just read a report about how Dollar General got downgraded this morning, that there's pressure there. So it seems like it's hitting every economic income strata when it comes to this situation, this cycle.
I mean, here's the way to think about it.
Okay.
We have roughly 10% inflation. Wages are growing at 5%. So on average, everyone just took a 5% pay cut last year. The lowest income classes have to spend less on less money, right? They have less money or they can borrow money. The wealthier, it doesn't hit as much because they don't spend as high a percentage of their income.
Right.
But the stock market's down 20%. The bond market's down 10+%. Their wealth is down, probably 15 to 30%. So while inflation doesn't hit them as hard, they pay the same prices as everyone else, but their wealth, got reduced by a fifth or a quarter or whatever it may be. So they're starting to, again, batten down the hatches.
Yeah, there's a contraction in that wealth effect for sure.
Yeah.
And I think it's also the political climate. I don't know numbers about this, and also where we might go. I just think people are less confident. We see that in consumer confidence. We see that in the small business indexes, right? That tell us where small businesses are from an optimism standpoint. It's not there.
Right.
What's been stubborn is unemployment and where we are from an employment perspective, right? I know the labor force participation rate isn't where it was pre-pandemic, and you have to take into account population growth over the last 2 years to figure out that there are still a lot of people on the sidelines that have decided not to go back to work. How do you think unemployment gets affected here as the Fed continues to tighten and conditions worsen? And this is where it's so unusual, right? Post-pandemic, how it may not act as it did before as far as what kind of unemployment rate you're going to need to see to really create demand destruction, even though we're seeing it in some form right now.
I think that the destruction in the job market will be slow and then fast. I still think there's, from talking to people that own smaller businesses to hearing what companies are saying, like the small business survey, NFIB, which came out Monday or Tuesday, said that 50% of those surveyed are still having trouble hiring. So they're still trying to hire, and they can't even hire the people they want to hire, despite the fact that their expectations are the worst they've ever recorded. Talking to my brother who runs a print shop, he said, I can't fire people. It took me so long to get these people. They're borderline competent, but borderline competent is good enough right now after everything he's been through. So I think it's just people are going to be, or businesses are going to be very slow to let people go because they know how hard it is to rehire people. But at some point, they don't have a choice. Business slips. They're not making as much money and they have to cut somewhere. And at some point, that's where they cut. And that's why I think the unemployment rate, the jobless claims rate, which will come out this morning, will get worse. And then it'll get really worse as this continues. And maybe that'll be later this year, early next year. And that poses a problem for the Fed because it kind of masks what's really going on. The Fed is, in theory, supposed to be concerned about two things: prices and jobs. So they're saying, well, the jobs market is fine. Look at this. We're still at very, very low levels, even though there's been a slight, it's gotten worse very slightly. But prices are sky high. Let's just focus on prices and not jobs. And I think that's we talk about these Fed traps. That's a huge Fed trap. And to be honest, I don't have the answer for the Fed. They've set these traps. Right. Now they're falling in them. So it's going to be tough sledding ahead.
We might see, interestingly enough, more white-collar unemployment in this cycle.
Oh, absolutely. And, they're easier to hire in many cases, and they make more money. So maybe it makes more sense to fire the one executive instead of 10 of those line workers that you just can't find.
Hey, when we get back, I want to talk about the dollar, King Dollar, as the dollar soars here when you look at the dollar spot index this morning and what it means for earnings, what it means to overseas markets. So I'm Rich Rosso here with Mike Lebowitz here on The Real Investment Show. Stay tuned for our next segment. We'll be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Elon Musk recently took a large shareholder position in Twitter. He made some comments that Twitter should be the town square where everybody can freely have their opinions heard without censorship, etc.
The Real Investment Show podcast. Same show, your schedule.
The staff at Twitter are apparently so triggered, they were even stressed on their monthly day off for a day of rest.
At realinvestmentadvice.com.
It's called the weekend, folks.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
Texas is that feeling when you open the oven to check on your cookies and you burn your face. And there are no cookies. And you can't shut the oven door. That's thanks to Brent Clanton. And boy, is that the case.
Man.
Whew. Man, I know I already talked about this on the radio show, but when I was in Luling, the car registered a temperature of 120 degrees. That's the first. And Amy goes, and baking alive. I'm like, you're from here. You're used to baking alive. But man, it is at another level. Speaking of hot.
Yes.
The Bloomberg Dollar Index just hit its highest in data going back to 2005. I mean, the dollar, Mr. Lebowitz, is on fire. Give us
Dollars and fuego.
And fuego. I mean, so I think the euro has fallen 12% to the dollar, right? I think we're close to or exceeding that we're at dollar parity now with the euro. But go through it. And people don't understand because, I talk to people every day. You know what they tell me? Oh, the dollar stinks. The economy's, the U.S. is collapsing. I said, listen, have you looked? I understand because of inflation how you feel. But have you looked at a dollar index lately? It's a Salma Hayek thing going on there. So, so why don't you go ahead and give us an idea of the good and the bad?
Can we put
Salma
on the dollar?
Bad, the ugly.
We could put Salma Hayek on the $100 bill.
There's a lot to unpack with the dollar. Mm-hmm. It affects so many different things. I think the first thing to realize is that almost everything in this world trades in dollars. So even if it's a Canadian company trading with a company from the Philippines, they're using dollars. So everyone uses dollars, and they have to convert their currencies to dollars and convert it back to their currencies when they do these transactions. They also keep money in dollars, and that's what helps support our bond markets and, to a much lesser degree, other capital markets, stock markets. So when you think about the dollar, the first thing I think a lot of people think about is, how does it translate to other currencies? Mm-hmm. And like you said, the dollar is up about 8% in just the last 2 months. That means if you took a trip to Europe 2 months ago and you're taking another trip to Europe today, Lance's trip was 8% cheaper this time than it would have been 2 months ago.
That means I better get more stuff.
So that means, it's
you better
time
be buying
to travel.
It's time to travel.
It also means that everything we buy, and we are a net importer by a long stretch, has become cheaper. Mm-hmm. So there's the positive. There's the good. Right. Is that it is tempering inflation. Inflation would be worse, believe it or not, if the dollar was weak. But the dollar's strong against just about every currency. If you look at it, it's the dollar index, which is primarily the dollar against some combination of the euro and the yen, and then a few other currencies. But it's the euro and the yen that kind of drive the dollar index. The dollar index has risen about 8% in just the last 2 months, and over the last year, almost 20%. So that's a lot of purchasing power for people traveling abroad or buying products abroad. Now, the problem with it is it makes it rougher on our exporters that want to sell product abroad for just the opposite reason, that those prices are now 8% or 20% more expensive. And as we look through corporate earnings, start thinking about which companies tend to import goods and which ones tend to export goods. And I think that'll really help you get a better gauge on who may outperform or underperform expectations, because it's certainly having a big hit. Now, what's important is that they hedge. They're not just blindly relying on where the dollar, the euro, the yen, whatever currency, the Canadian loonie, whatever it is, right, Australian dollar, they hedge. The question in many businesses is how well do they hedge? So corporate earnings will be affected. Some of them probably hedged very well. Some of them probably didn't hedge well enough. And it may positively, it may negatively affect earnings. But I think the much bigger ticket item, and I think this continues to be underappreciated, and it's kind of crazy. There is approximately, and it's hard to put an exact number on it, but somewhere between 10 and $15 trillion of money borrowed in U.S. dollars abroad. So what that means is, let's just take an Italian. They convert their euros to dollars. They borrow money in dollars. Mm-hmm. They convert it to euros. They buy something, a factory, a house, whatever it is, in euros, and then they have to make their payments in dollars. And at the end of the day, they have to pay back the principal in dollars. So with both the interest and principal, they have to pay dollars, but that rate is always changing. So when we take out a mortgage and we're paying 4%, we take out a $100,000 mortgage and we're paying 4%, we're paying that same $4,000 every year. With someone borrowing abroad, it doesn't quite work that way. They have to, every time they have an interest payment, they have to pay it in dollars. So if you look at a company that was in Europe and borrowing in dollars, their interest payment from just 3 months ago to today just rose by 8%. And if they have to pay back the principal, that rose by 8% as well. So what's really going on here is, we're worried about the Fed raising 1%, mm-hmm. that they've just raised 0.5%, 75 basis points. Over the last 3 months, the euro just, for all these dollar borrowers, rose 8%. this is going to have a big effect on the global economy. The Fed is really, and the market, not just the Fed, is really tightening global monetary policy.
Right.
To a massive degree. And I think what's interesting, and believe me, the central bankers know this, and we've started to hear them talk about how they may have to intervene in markets. They say it more gently than that. But they're basically talking about how it may be time for them to make sure markets trade. Their code word is trade orderly, meaning don't go to where we don't want it to go. And we've seen that with the euro. The euro is almost just about down at parity, meaning that €1 equals $1. That is down from 120 not that long ago, 115. So that's it's just a number. One is a number, 98 cents, 102 are just numbers. But that's a key number, I think, in the market size. And if a dollar breaks, if parity breaks, the euro could go much lower. And I don't think the Fed wants that. I don't think the ECB, European Central Bank, wants it. And if you look at kind of a short-term graph, and by short-term, I mean 5-minute, 1-minute kind of trading, you see that there's been a good amount of support for the euro right above parity. So, I think what we're starting to see is the central banks realize that they need to step in a little bit, and the dollar may take a breather from here purely because the central banks can't afford to let the dollar strength continue.
So think about this from a portfolio level perspective. I'm told, right? I'm told, even though the market theories have been bastardized by Wall Street to serve their needs, and I'm told I should be diversifying all the time into international and emerging markets, no matter what, because I'm spreading my risk. How is that going to work for you today? If I have, say, half my equity exposure in I put 25% in emerging markets, I put the rest in developed Euro markets along with U.S., because that's what I'm told.
Yeah, it's, and again, the bigger problem too is that they're doing it passively. So they're just buying the broad index.
Right.
They're not buying those companies in the emerging markets or developed markets, foreign developed markets, that actually may do well with a stronger dollar.
And you're right. I'm assuming it's more of a passive indexing kind of approach.
Right. And that's a problem. And look, we've seen foreign markets have gotten hit worse than the U.S. markets. They tend to be, and they tend to be more commodity related, less tech contribution to their indices. But they've gotten hit worse, and it's because they're more affected by higher interest rates. They're being affected by the dollar greatly. And, there's also a flight to quality. The dollar is rising, so some money is coming back to the U.S. because you can get much higher interest rates here. And you have, quite honestly, a Fed that is, compared to many other central banks, doing the right thing. They're fighting inflation, and they're fighting it aggressively. If you look at what the ECB is doing, they're taking baby steps to fighting inflation. Maybe we'll raise by 25 basis points. And Japan's doing the opposite. We're going to keep easing. We're so concerned because our 10-year rate may go above 0.25%. So, in the grand scheme of things, the Fed is the hero. But part of the problem being the hero is the dollar and what's going on with the dollar.
There is no savior to diversification in down markets. And international is not going to protect you, as people tell me, and as brokers will tell me today, that if I have domestic and international markets, that I've expanded my opportunities. Well, I've also increased my risk, possibly more than I want to. So it's not, you can diversify very easily across the board without touching international. It's trying to time it as best you can. When we get back, we're going to talk about some municipal bond issuers are falling behind on disclosures. Is there a reason why? With Mike Lebowitz. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hurricane season is here, and along the Texas Gulf Coast, we know how to prepare. What we don't always know is which way the storm will go, and if a hurricane does come your way, whether your house will flood. Fortunately, you can get flood insurance. Unfortunately, flood insurance rates have skyrocketed. Don't be at risk. Let the specialists at RIA Insurance assess your needs and shop your coverage for the best rates possible. Another service from realinvestmentadvice.com. Click on the insurance tab, realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the Real Investment Show. I'm here with the Professor Michael Lebowitz. All things Fed and macroeconomies. I can see you teaching at a prestigious university with those patches on your jacket with your pipe.
The prestigious 2-year college.
Hey, you know what? Listen, I wrote in my book that every prospective college student should go to community college first to get their basics. My daughter did that. It worked great. Best deal on the street.
I don't disagree.
Yeah.
Even though my kids are all doing the 4-year pay as much as you can route.
Well, you know, you and Lance have the big bucks. I live on the poor side of town.
Big money. Professors make a lot of money.
You're tenured. Morgan Stanley, they missed. Obviously, it talks about where risk-taking is, right, when it looks at the collapse in IPO markets and debt and equity issuance this year. So what are your thoughts on, the hits just keep coming here today?
Yeah, so JPMorgan, I think, tells us more about the broader economy.
Right.
Morgan Stanley is more of an investment banker. They're not making nearly as many loans to mom and pop or to small businesses. They are much more a deal maker, IPOs, SPACs, a little more market oriented. Not to say they're not making loans. So I think it tells us what we kind of already know, that IPO issuance this year is horrendous. So there's not much revenue coming from that. SPACs have been in the toilet. It's just deal making is very low this year. So Morgan Stanley is kind of getting hit. You know, their miss is more because of the markets. JPMorgan certainly lost money because of the markets too, but they're also more a tell of the broader economy. And banks have been trading poorly. The financials have been trading poorly. And the other thing to think about, and we haven't brought this up yet, is the yield curve. So the difference between bond yields, the 2 to 10 year bond, the 2 to 10 year curve is now minus 15 basis points, meaning that the 2-year has a higher yield than the 10-year. Well, if you think about how banks traditionally run their businesses, they take in your deposits and they pay you a very short-term rate, and then they lend it out at a longer term. So the difference between the 2 to 10 year, the 1 to 10 year is often seen as a proxy for bank margins.
Right.
And right now, those are flat to negative. So not to say they're losing money on loans, but their margins are coming down rapidly, are shrinking rapidly. And that's also weighing on the banks. And, we've seen them trading poorly as we've seen this pretty abrupt shift in the yield curve just over the last week or so.
Well, you see like a lot of these regional bank stocks have been taken out to the woodshed. I mean, they are down. And it makes sense, to your point. Makes sense. And it does make sense why Morgan Stanley missed. I'd have been shocked if I'm surprised that the earnings came in as close as they did.
Right.
But maybe in the next quarter, we'll see if that gets worse.
Right. Now, banks can really sway their earnings. They can move money around. What banks are doing, and I haven't looked at this for JPMorgan yet, but they will most likely set aside cash in reserves for potential losses.
Right.
So the question is, how much did they set aside? Was it not enough? Too much? And that's what we don't know. Now, conversely, when we get to the other end of this, they most likely will have put aside too much and they'll be releasing it. And we've talked about that, and that helps earnings. But in the meantime, look, I don't know what JP Morgan did, but hypothetically, let's say they didn't put aside any reserves. They may have beat on their earnings number, not revenue, but earnings
on
number.
Earnings.
But so you got to take all this with some grain of salt. And with financials, so much more than most companies, you really have to look at the details. Speaking of which, Pepsi released their earnings on Monday or Tuesday.
We're snacking.
Here's what I thought was very interesting. Unit sales. So how much of the stuff they actually sold by product, by weight, not by revenue dollars, was up 1%. Sales were up 12%. So Pepsi, Frito-Lay, I'm not sure what else Pepsi sells, all the beverage products, they're passing on the cost to the consumers.
Right.
So
they're paying.
Pepsi, at least, that's
there's
great.
pricing power there. I was shocked. But
they have pricing power.
Like you said, I mean, a lot of companies are going to lose that ability to pass on. I think it's because it's such a diversified portfolio of different foods that people eat all day that they're able to get what they're able to get. It's rare, but I think Pepsi put themselves in that position, which is great.
And look, I don't even know what a can of Pepsi costs anymore. I haven't drinking that stuff in ages, but let's just say it went from $1 to $1.10 for a can. It's 10% inflation. That's a lot of inflation, but it's a dime. So, I think a lot of people just it's not the percentage, it's the dollars. So maybe on some of these very low cost items, those kind of companies can pass on the cost more so than the higher ticket items. That's another thing to keep in mind this earnings season is what are they selling and how well can they pass on higher inflation to their consumers.
So, in other words, people are still eating the Doritos.
Maybe Doritos and Pepsi are for dinner now.
It's Doritos and peas.
That may be that may be the bigger problem.
Nana Clara is working with Pepsi now and Doritos.
Is there a Dorito Pepsi soup she can make?
It reminds me of the Three Stooges when they go, we're having filet of sole and heel. When things were rough. So here's an interesting perspective. S&P Global Ratings withdrew ratings for 30 cities, counties, and municipalities because they hadn't filed their 2020 financial statements. And obviously companies are really good at, there's the timetable that's mandated for corporations, obviously for U.S. corporations occur. But there's a lot of late disclosures going on in the municipal bond market. I think I know why, but do you have any idea what that would be? What's causing that?
I'm guessing they're very short-staffed, that they have not only short-staffed, but incompetent staffed because of what happened over the last 2 years.
I'm thinking they didn't want to, based on budgets and what's going on with the markets, and obviously their ratings are in jeopardy. I mean, I just think that a lot of muni balance sheets are in trouble. And maybe
I think it could be all the above, and now they're being faced with much higher borrowing costs. So they're trying to, the higher rated you are, the lower your borrowing cost. So, if you put yourself in a municipal shoes and they're AA rated, but they know that if they disclose what they're supposed to disclose, how much money they borrowed in 2020 or 2021, they would get downgraded. Well, that downgrade may cost them 0.5%, and they're worried. Right now, their revenue, especially states that have income taxes, is fine. But I think they see what JPMorgan sees, and they're going to be borrowing more. So I don't disagree with you, but there's probably a lot of factors driving that.
Well, it looks like they were saying, okay, so there are many municipalities in South Dakota, Florida, Ohio that have filed on time. It's just going to be interesting to see because there's got to be a lot of distress on the books for municipal markets overall. So we'll see. But what are your thoughts on, I think we have PPI coming out this morning. Is that right?
PPI. Well, here's what's interesting. And if you read our commentary that's going to come out in about a half hour, I think CPI is flawed. And it's flawed in that the prices of goods tends to be delayed. And we've talked about this before, Lance and I have. So house prices, food prices, gas prices are not necessarily in the last CPI report from June. There's some combination of averages going back all the way to March. So what you're going to see if you look at today's commentary is that the price of all the futures products for all kinds of agricultural products and energy products, they all peaked very late May, very early June, and all of them were lower for the month of June. Some by as much as 30-40%, some by only a few percent, but most of them were at least double digits lower. So you go and you look at that number yesterday, it was driven higher by a lot of things, but food, energy, and shelter. Shelter primarily rent. Well, we have a good feeling that house prices are coming down, that rent prices are finally kind of hitting the wall and maybe have started slipping a little bit. But we know that the underlying food, agriculture prices, we know gasoline, crude oil is down to $93 this morning. Right. It was 120 plus not that long ago. We know the gas at the pump, it's still very high, but it's, here at least in D.C., it's in kind of the mid fours.
It's come down here.
It's not that long ago.
Yeah, it's below 4. So we should hear less screaming about that. But when you look at the Atlanta Fed and you look at their sticky price index, what's very concerning is to see how it's running. And those are the prices that take long to change. That sticky price inflation has been increasing over the last few months.
And I think that's what scares the Fed. The Fed's kind of thinking, okay, we'll get inflation down, we'll get food and energy down, but where does that leave us? And maybe it leaves us at 5%. Because of all these stickier prices that don't really go up or down as much. And I think that's what's concerning to the Fed is that at the end of the day, after they do all this, they still have an inflation problem, albeit 5%, not 8%. So
listen, you got to sign up at Real Investment Advice for the daily commentary, Lance's newsletter, to keep track of Mike's writings. You got to Mike and Lance, they're writing every day. So you'll take a look at the blog this morning. Thanks for being with us. Tomorrow, Financial Fitness Friday, Danny Ratliff will be joining me. Thanks for listening in today. We appreciate it. Have a good day.